How does a binomial tree calculate Greeks? Have you ever wondered how traders measure the sensitivity of options prices to various factors? The answer lies in something called the Greeks. Today, we will discuss how a binomial tree calculates these Greeks in options trading. In options trading, the Greeks are essential metrics that show how the price of an option changes with respect to factors like the underlying asset price, volatility, time, and interest rates. The binomial tree model is a popular numerical method for pricing options. It can also be used to calculate the Greeks by analyzing option values at different points in the tree. Let's start with the basic concept of the binomial tree. This model predicts possible future prices of the underlying asset at specific time intervals. At each step, the price can either move up or down by certain factors. At every node, the option value is calculated based on the expected payoff, which is then discounted back to the present. This structure helps track how option prices change as the underlying price moves through the tree. Now, let's talk about delta. Delta measures how sensitive the option price is to a small change in the underlying asset price. In the binomial tree, delta is calculated at the first step. You take the difference between the option values at the up node and the down node, then divide that by the difference in the underlying asset prices at those nodes. This gives a good approximation of how the option price reacts to changes in the underlying price. Next is gamma, which measures how delta changes with respect to the underlying price. To find gamma, the binomial tree uses the deltas computed at the second step nodes. You calculate gamma by taking the difference between the two deltas at the first step nodes and dividing by the difference in the underlying prices at those nodes. This helps capture how the option price curves in relation to the underlying price. Theta is another important Greek that represents how the option price changes as time passes. In certain binomial tree models, like the Cox-Ross-Rubinstein model, theta can be estimated by comparing option values at nodes that are one time step apart. You divide the difference in option values by the length of that time step. For Vega and Rho, which measure sensitivity to volatility and interest rates respectively, the binomial tree does not directly calculate these from the nodes. Instead, traders typically estimate them by recalculating the option prices with slightly adjusted volatility or interest rate inputs and measuring the resulting changes in option prices. Using binomial trees to calculate Greeks has its advantages. This method allows for simultaneous calculation of option prices and Greeks. It can easily handle American options, which have early exercise features. The calculations for delta and gamma are straightforward, relying on simple differences between node values. More advanced algorithms can improve the efficiency and accuracy of these calculations. Traders often use the Greeks calculated from binomial trees to manage risk and create hedging strategies. For instance, delta helps in forming delta-neutral portfolios, while gamma indicates how stable delta is as the underlying price shifts. Theta is crucial for understanding time decay, and Vega and Rho assist in assessing exposure to changes in volatility and interest rates. In summary, a binomial tree calculates Greeks by examining differences in option values at adjacent nodes. This method provides discrete approximations of sensitivities like delta, gamma, and theta. It integrates option pricing and risk measurement in a flexible and manageable way, making it a useful tool for stock traders and options market participants.